The key question we are addressing is, with the strong rally in the market, is there still upside potential? And if it is too late to get back into the market? The short answer is yes. We still see upside. Let me walk you through why we believe it's not too late to invest, the key drivers behind the market's momentum, and also the opportunity and risk to consider. In short, no, it is not too late to invest. We see potential for further upside in the Chinese equity market, driven by multiple catalysts. However, given the high base after the rally year-to-date, the extent of gains may not be as dramatic as what we have seen previously. Let's start with the drivers behind the year-to-date rally and why we expect further improvement. The fundamental drivers for the rally so far have been in their early stages, and we expect to see the sector fundamentals to strengthen further. Here are the key sectors and themes. Firstly, artificial intelligence. We see a widening of AI application across industries. From manufacturing to services, AI adoption is accelerating, creating new growth opportunities for companies in the space. Secondly, humanoid robots. This is an exciting area where we are moving towards large-scale commercialization. As humanoid robots become more viable, companies in the sector are likely to see significant growth, supporting market momentum. And also healthcare sector, the series of huge outsourcing orders won by the Chinese biotech companies due to their strong cost advantage should benefit the entire drug development value chain in China, when they gradually start their clinical trials and then the manufacturing of the new drugs. Another critical factor is the ongoing assets reallocation into equities. We are seeing capital flows from the bond market and household saving onto the equity markets. In particular, the dividend yield for the CSI 300 index is currently 2.6%, significantly higher than the 1.8% yield on the 10-year Chinese government bond. This makes equities an attractive alternative to fixed income products. Similarly, reallocation from household saving to equities is just at the beginning. The decrease in the saving ratio has been mild so far, but as households become more confident in the equity market's strong returns, driven by the recent share price rally, we expect the trend to accelerate. This shift should provide additional fuel for the market's upward momentum. Now, let's talk about foreign fund flows, which are another key catalyst. Over the past few years, foreign investors significantly reduced their exposure into China equities. However, with improving industry fundamentals, solid corporate earnings growth, and the continued outperformance of the Chinese market, we expect foreign investors to gradually reduce their underweight positions. We are already seeing mild inflows from overseas hedge funds and regional long-only investors. As confidence grows, we anticipate broader participation from global long-only funds, which should drive valuation improvements across the Chinese market. That said, we must acknowledge the risks. Geopolitical tensions, economic growth momentum, and other macro factors could lead to market volatility. Sectors or stocks with high valuations after the recent rally may face profit-taking pressure. However, we view any correction as healthy and, more importantly, as buying opportunities, especially for high-quality companies with strong fundamentals and capability to sell and compete overseas, whose value should become more reasonable after a price pullback. We are addressing two questions about the recent A-share market rally. Who are the main buyers, and why does strong market performance contrast with the weak economic data? Let's explore the buyers and the reason for this disconnection. The rally is largely liquidity-driven, with two key buyers groups. First of all, domestic retail investors are flocking to equity, which offer better returns than underperforming assets like properties, bonds, or saving. And insurance companies are also reallocating from fixed income products to equity, attracted by the higher dividend yield compared to bond yields. Despite weak economic data, the A-share market is surging. Here is why. Valuation expansion, fueled by liquidity and assets reallocation, is driving the rally, even if economic fundamental lacks. Secondly, the market often moves ahead of fundamentals, pricing in expected economic recovery from government's potential policy supports, which may take time to impact the real economy. And finally, the new economy sectors like internet, e-commerce, EVs, biotech, AI, and clean energies, etc., is now representing around 60% of the market, while only 40% of the market is tied to macro-sensitive or economy sectors like banks, properties, etc. This shift means the market reflects innovation more than macroeconomic conditions. The AI supply chain is long and deep, offering diverse opportunities beyond the internet names found in the Hong Kong market. In addition to the internet names in the H-share market, the China A-share market also provides exclusive access to critical parts of this value chain, including, firstly, let's talk about the opportunities in AI infrastructure that are only available in the A-share market. Networking and communication. That includes companies producing optical transceivers and servers, etc. And secondly, computing power. For example, chips designer for GPUs, CPUs that drive AI processing capabilities. And also PCB manufacturers, which are indeed the key components in all electronic equipment that enables AI functionalities. And also thermal control systems, including companies developing liquid cooling solutions for AI data centers. And power supply management, for example, business focusing on UPS and energy storage systems for reliable operation in AI data centers. And also materials, including suppliers of fiberglass and other materials that are critical for AI components or infrastructure. There are also unique opportunities related to AI applications. For example, smart home and appliance, including companies integrating AI into home automation and consumer electronics. Another example would be autonomous driving, such as those auto parts manufacturers enabling AI-driven vehicle technology. Some people may see having high exposure to the AI value chain could lead to concentration risk, while we do observe the potential risk and diversify also into other traditional sectors like utilities, commodities, banks, etc. We do want to highlight that in the longer term, AI would eventually become universal in the China market, penetrating into all industries, especially among the industry leaders. Therefore, investing in China in the longer term, you will essentially be investing in a basket of AI beneficiaries. Therefore, in order to capture the full potential of the AI value chain, investors should not focus solely on the H-share or A-share market. The China A-share market offers unique opportunities in AI infrastructure and applications, complementing offshore markets. By investing across both, you can position yourself to benefit from the widespread adoption of AI in China.